So if we say, and now what does this mean for investing? Well, if we say interest rates are going to go up, that's not good news for fixed income. Now, we're not saying interest rates are going to go up quickly and by a lot, but definitely the path has to be up higher, and it will happen over a period of time. That's bad for bonds, and that's one of the reasons why we think equities are a preferable investment right now than bonds. Now, the pushback we get on equities is, well, the market's been going up for 8 years. If you look at this chart, actually this bull market is the second longest, fourth highest bull market in history, and valuations are very high. And I just said interest rates are going to start going up and inflation's going up. These are headwinds for equities. But we think there's still room, and especially given the economy with what's happening, and we think the next year or two at least the economy should be improving, there's still room for equities to move higher. Case in point, if you look at interest rates, you can see this chart. It's showing 10-year Treasury yields, and you see valuations and P multiples. It's true. When interest rates go up, valuations go down. But see where the inflection point is. It's at 5%. Right now, we're more at 2.5%. Actually, we're more closer to 2.3%. There's plenty of room for interest rates to move higher before you hit that 5% inflection rate. It's the same story with inflation. If you look at this chart, the blue line is showing inflation. Anytime inflation tends to go over 4%, you see the green line there dipping down. It shows valuations going lower. But however, when inflation is below 4%, look at the green line now, valuations actually spike higher. And right now, so if you look at the bars on the right, you can see the sweet spot for valuations is actually when inflation is between 1% and 3%. We're lucky to get to 2% right now. There's room for inflation to move higher, and there's room for interest rates to move higher. So we think equities are a better place to be right now than fixed income. The other thing we think is more optimistic is active management. There's been a lot of press, and John's going to talk about this as well, but there's a lot of press about people putting more money into passive investments, exchange-traded funds. Now, if interest rates are zero, it's very hard to differentiate between a good company and a bad company. The cost of capital is zero. But as interest rates start to move higher, that differentiation will grow. Now, when correlations are very low, active management does very well. And we think that as interest rates start to move higher, we think those correlations are going to again start to move lower, and then active management should outperform. So we think this is going to be a better environment for active management. And it's not, this issue is not just within stocks, it's also within asset classes. Again, when interest rates are very low or near zero, all asset classes, all assets, all investments do well. When interest rates start to move higher, there's going to be more diversification. There's going to be some winners and some losers, and you're going to want to have a more diversified portfolio like David was talking about. So let's sum it up. The rise and fall of the American empire, we see the risk, but we don't think so. Mainly, we think the economy is going to start to it was starting to reflate before the election, and we think it's going to continue. We think Trump's policies could help. We believe that because of that, risks are to the upside, but we think also in this environment, monetary policy is going to have to start to normalize, and interest rates are going to have to start moving higher. Because of this, we think equities in the short term are the better investment over fixed income. We think also active management makes more sense. And finally, diversification is the only free lunch in investing. With that, I'm going to pass it over to John.